As I'm sure you've heard, the Fed have been very busy in the background, kind of beating up the economy, pulling the only lever they can at this point, and that is raising the Fed funds rate. They do that for two reasons. One, to increase the cost of borrowing for the American consumer, and two, to increase the cost of borrowing for corporations. And the idea there is from two different angles to reduce spending, increase unemployment, and ultimately kind of work inflation back down to reasonable levels. What they're doing working. How is that being responded to? How's the market reacting? How's real estate doing? And that's what I want to dive into with you here. So let's start at the beginning of February. When the jobs report came out early February, it was a big surprise. 517,000 jobs were created versus the anticipated 185,000 jobs. So that's a big difference, and really that's how the markets react. Is they set their expectation. If it comes in low, high of that expectation, there's a reaction. So when we saw that jobs number come out, mortgage rates did not like it. We were in a really good range there. Kind of leading up to early February, and we've backtracked a little bit as a result. Over the past couple of days here, core CPI numbers have been released, and reaction has come out to that. And what we've seen is year over year, inflation is improving. However, month over month, inflation is a little bit higher than expectations. It's all about expectations, and coming in higher than expectations is not a good thing for mortgage rates. Seeing kind of two big forces in the market forcing mortgage rates higher. The Fed is still busy working away in the background to push inflation down, push unemployment rate up. So ultimately, that will help mortgage rates. And if you're a real estate agent, ultimately the cost of home ownership should come down as a result. It's just we're kind of stuck in that in between until we really start seeing some traction. So active listings year over year up significantly. Under contract down minimally. New listings down, which is interesting. Sold listings is down. Days on the market is up quite a bit, I think because of volatility. Median sales price is down, but really pretty similar to where we were January 2022. Median sales price is similar, but down a touch. Average sales price is up a touch. Percent of list price received is down a bit. So rather than being greater than the list price, we're a touch under, which does signal, I think, market demand. And the big one here that I've kind of been building up to is affordability index. So this is a measurement of the median average price point relative to the median average household income. We're still out of whack. House prices, the cost of home ownership is greater than the household average income, negative 17%. Let's compare that to previous months. So if we go back into 2022 and look at housing affordability, starting in February, we were at 20%, 26%. So housing was becoming more and more and more unaffordable all the way up until November 2022. And then you can see the market shifted. Rates did start to improve a little bit. So we're seeing progress there. And there's multiple reasons why. To put my finger on really two notable reasons why affordability is improving is one, the price points of homes we have leveled out a touch. And then two, mortgage rates. When we peak, housing becomes very, very unaffordable, and it bears out in the numbers. And then as we start to come off that, housing becomes more and more affordable. So from that perspective, we are trending in the right direction. 2023, will be a volatile year, but ultimately we should make quite a bit of progress. There is a window of opportunity, less demand in the market, and that gives more opportunities